As you can hear by what we've been talking about, we got a lot to talk about this morning, so let's bring in David Gitlitz. He's the chief economist at Trend Macro Analytics. Also Kevin Carone, who's the market strategist at Stifel Nicolaus. And guys, I want to start off with this morning. David, why don't we talk a little bit about what we've been talking about around the table. The idea that Washington is now being asked by the automakers to step in. What would happen if they didn't step in? What are we talking about in terms of unemployment and the drag on the economy?
Well, it wouldn't be good, sure. There's no question about that. But you've also got to ask the question, you know, at what point, how far does all these government bailouts, how far does that have to go before we reach the point where we're going to say enough is enough?
Right.
Yeah, I mean, GM. Let's face it, GM has been essentially a dying company for a long time. And so now it looks like it's in really bad shape, and so now it's going to be up to the government to try to rescue it here. But it seems to me that it's from a long-term perspective, it's probably futile. Okay, unless GM can build quality cars that people want to buy and can find some way to deal with its legacy costs that have so crippled it. It's just not a viable going concern for the long term.
Kevin,
you know, at what point do we just face that fact and deal with it?
Right, Kevin. These are very difficult decisions. It's got us all talking this morning. What do you think about what you've heard? Is this a situation where they are very likely going to be given this money? What do you think it means for the market, and how are you kind of measuring all of this?
Well, I think that we continue to be in a bear market as the economy struggles very hard to delever, which of course becomes compounded more difficult as asset prices fall. So the fact of the matter is that the government is stepping in to fund big voids in investment dollars, which used to come from the private sector. And what we need to be concerned about, as far as a risk case is concerned, is that we don't follow the Japanese model where we step in and continually engineer bailouts, so we never get to the point of understanding of allowing the system to flush out naturally, so that we can have a recovery at some point. I'm very concerned, for example, that what we're doing in the banking system is keeping the bad assets from coming to the surface. And I remember most of the time during the 1990s, when there was a complaint levied against what was happening in Japan, it had to do with the fact that they weren't coming clean enough, quick enough with their own finances to be able to get themselves out of what ended up being a decade-long deflationary problem. So that would be the risk.
Although the other question is, would you suggest that we do nothing at this point, that we not step out and bail out some of these companies? You're looking at AIG this morning. That the amount of the bailout there jumping to $123 billion today, up from 85.
Yeah, there's a tendency to want to get a quick fix. The bailouts are part of that quick fix. And I'd also point out that when you look at the Fed's balance sheet, it has increased, it has doubled in the last several months to $2 trillion in size. And the percentage of that balance sheet that is in the form of U.S. Treasuries has fallen from 85 or 90% to little more than 20%.
Right.
So these things are historic in proportion, historic in nature in terms of the types of things that are trying to be engineered to resuscitate a global economy. And it speaks to the structural problems that are now confronting the global economy.
David, the bad news, I guess, are these bailouts. The worst news are when you start seeing the jobs number that we had on Friday. You hear from the retailers about how consumer spending has shut off. What does this all add up to for the economy?
Well, the economy is in bad shape right now. There's no getting
Is there any way to qualify it? Like, where are we headed?
Well, it all depends on how quickly, and with what rate of kind of acceleration we get some degree of confidence back in the system, and you get risk taking being regenerated, and you get people putting capital at risk. That's the answer to this, is to get out of this crisis of confidence, so people can again have some degree of faith that, you know, that their economic bets are gonna pay off again, and we're just not there yet. Now you see some encouraging indicators in the short-term credit markets with the LIBOR rates coming down, the TED spreads, coming down quite a bit here in the last several weeks. So there's a process of thawing out of those markets that's going on, and over time that'll pay off in terms of people being able to absorb risk again.
Right.
But we're just not.
Are these AIG numbers new? These are new, Ann?
Yeah, they are.
But those
342 on the loss, the non-GAAP loss.